Welcome back to the Jack of All Trades podcast, episode 2. I can't
Good
count.
try. As you drink out of your Tusk mug.
The horn mug that I got from the Pickering flea market that just closed.
That's literally the most masculine thing I've ever seen in my life.
I'm making homemade mead right now, so I'm getting it up to 11% alcohol. So this has got a kick to it. But I'm like, if I'm going to be drinking what the Vikings drink, then I got to be drinking out of what the Vikings are using too.
Absolutely. All right, so I think on this episode we wanted to get into a little bit more like the day trading side of things, just kind of what to look for, like how to find patterns, just some kind of key things, how to track them and stuff like that. So I think we'll just get right into it here. If you want to pop over to my screen. So yeah, right now. So this stock right here, the ticker is BTBT. It's what was the date on this? So I'm looking at this day right here, which was December 28th. So you can see we had this day. It opened at 6. Well, you can see the lows and the highs are written over here. So low was 625, the high was 1245. So roughly around 100% move or so in a day. So the reason this one interests me is when I'm looking at these kind of things, like my ideal play is I don't like something that's gapped up like crazy. Like if this stock, for example, this is the daily chart, by the way. So each one of these candles is one day. So like if this stock was to, open like way up here, for example, I wouldn't really be too interested in it for a long, just because like it just gives it a lot more room to fall. My favorite setups for like a day one green day, as I like to call them, is something that opened like kind of right near yesterday's close or slightly above it. And then you get a good move in the morning. You can see the volume down here is quite high. We're up at, I don't know, say 60 million shares or whatever. Whereas, the past few months, there's basically been really minimal volume going on. Here, do you want me to shrink that down a little bit? Might make it easier to see. There you go. Perfect. Yeah, so that's the ticker up there, BTBT. So yeah, like anytime I'm looking for something like this, what I'm looking for is I don't really want there to be too much overhead resistance in the past little while. So you can see it's, this is November. So for quite a few months, it's just kind of been fluttering along, not really doing a whole heck of a lot. And then we get this one pretty good shove. So that's something that I'll see, around 10 o'clock or something like that. I'll put my scanners out and we'll get into how to set up all those and everything later on. But basically, I'm looking for something that's increased, like say 10%, 15%, nothing like too crazy. And then this one caught my attention. So I like this daily chart. And then if you go over to the well, here, let's step back a little bit. I'm just going to jump over to my other screen really quick for you guys. Okay. So do you use this, David, FinViz? Do you use this to get any of your information or no?
No, I don't know this thing.
Okay, so this is the first thing I do personally. Anytime I see a stock that's moving, the first thing I do is I go to FinViz, type in the ticker up here, which is BTBT, hit enter, and then it just shows you your daily chart. It's free. It's just a website, finviz.com. You have to pay to not get all the pop-ups. But I'm too cheap. And then I look down here, and the shares float right there. I don't know if you guys can see that. Shares float, it says it's 32 million. So that's perfect for me. Like my sweet spot on these kind of plays is so anywhere between like 10 to 50 million is kind of my favorite spot to play. And the reason I like that is because there's a lot less, there's a lot less supply essentially, like we were talking in the last episode. So anytime a stock has a low float, that means it's going to move a lot further potentially and a lot faster, which is great for volatility. And the reason being is, obviously the less shares there are available for trade, if one person buys one share, it's going to have a higher percentage effect on the price of the stock than if it has a much bigger float. So just for example, if I'm to go over to, I don't know, Microsoft, for example, if you click on Microsoft, the float here, the shares float is 7.56 billion. So, if I'm going to buy 100 million shares, the stock price really isn't going to move that much. Whereas if we go back to, BTBT and I look at this, it's 32 million shares. So I could buy 32 million shares and I could own the whole company. So that's the first thing I look at. So if this float is between 10 to 50, then that's perfect. That's my sweet spot. Just from my own experience, like I won't trade anything that's over 100 million. Just because I find like when it gets over 100 million, the moves just get less and less and less, and you'll still see the same kind of pattern setup, but it won't necessarily have enough to push it as far. So if if I see a specific pattern and let's say I see a setup where I can risk 10 cents, then if the float is say 10 million, then if I see a really good pattern, there's probably a good chance that I'm going to make $1 for that 10-cent risk. Whereas if the float's 100 million, then like I might only be able to get it pushed up to maybe 50 cents, 40 cents for that 10-cent risk, even on an identical chart setup. And the reason is just because, the bigger the float gets, the more people buying the stock it takes to push it up. So, the smaller this number, the quicker it's going to move. You do have to be careful though. If you see stocks that are really low, like, 1 million, 2 million, 3 million, those ones you have to be cautious because you can get into something it's called a circuit halt, basically, where the stocks they become so incredibly volatile that they can, let's say it's at $1, it can literally in a matter of 2 seconds go from $1 to $3, and then the SEC, which is call it the the FBI for stocks, it's the Securities Exchange Commission. They basically monitor and regulate all the stocks on the stock market. They'll halt the stock. So you could, get into a position and it could spike up or drop down so fast because there's such a low float that the SEC will halt it. A lot of the times it'll only halt for, maybe 5 minutes is typically what they halt it for, but sometimes it'll be 10. And then, I've seen some horror stories where a stock will spike up and then it gets halted, and it gets halted for a month, and then it opens 80% lower, and you've just lost everything, right? Or, you short a stock and you get stuck in a short position, and then it could open 200% higher. And now all of a sudden you've lost your entire initial investment, and you also owe your broker, an extra 100%. So you have to be like anything that's under 10 million, I would say for anybody that's starting out, just avoid it, because like they're really, really volatile and you can get yourself trapped very quickly, and they move so fast that you have to be able to make really quick decisions.
You touched on something earlier I want to just explain in case our listeners don't know, like, because you mentioned gap up. So the markets trade generally from 9:30 in the morning to like 4 p.m. at night. And then there's pre-market and aftermarket trading. And then that's when you see the gaps, right?
Right. So yeah, when I say a gap up, I basically mean, let's say the stock closed at $10 and then they came out with some news at 4 p.m. and the stock, like certain brokers, like interactive brokers, I could trade for a period in aftermarket hours and pre-market hours. Other brokers allow you bigger time frames. Some brokers only let you trade during hours, which is most of them. So that's why the most volume happens during the day. But basically, like a stock can close at $10. They could have news come out. It could open the next morning at 9:30 at $12, or it could open at $5. It could open at a different price than it closed. So when we say gap up, that's what I mean is it's gapped up from the previous day's close.
Do you want to open up a screen just to show people, just in case they don't know how to read a candle, so they could get a really good idea of what a gap looks like, and then just even read a candle, basically where it closes, what makes a candle red, what makes it green, basically.
Okay.
Like we'll just start real basic, yeah.
Sure. Okay. So I'll flip back over to my other screen here really quick.
Because I remember when I first started trading, I thought a green candle means there's only buying, and a red candle means there's only selling. But that's not how it works.
Okay. So I'll zoom right in on this one here just so you can see it a little closer. So this is the day that I'm talking about again on this particular stock. So basically what a green candle means is the open price is the bottom and the close price is the top, meaning at 9:30 in the morning when the market opened, this is your price, 625. And then when the market closed at the end of the day, it was 1039. And then this little wick that you see on the top here, that's just when it went up to. So at some point during the day, it opened here, the stock went up, it went up, and it got to this point, and then it sold off, and then it closed right here. And then it's the exact opposite on a red day. So like if I kind of pop over to one of these little red days, like this one here, for example, you can see it's got a wick on both ends. So what happened on this one is the stock opened at the top of the red candle, and then it closed at the bottom. and then these wicks are the same thing. So this day it might have gone down to here, and then it might have gone back up to here, and then closed down at the bottom, or it opened here and then it had a spike in the morning, and then it went way down during the day, and then it came back up and closed down here. So that's basically the only difference between red and green candle. Green basically means, it opened at the bottom and closed at the top, and then red, it opened at the top and closed at the bottom.
Right. And actually, like at the end of the most recent one, that's a perfect example of a gap. You see the red doji with the giant green candle.
This one here?
No, on the 28th.
Oh, okay. Yeah.
Yeah, so we see like a red doji there, and there's like a maybe 20-cent gap.
Yeah, right here.
So that's what a gap up is.
Yeah. So this is like perfect, because when I'm looking at this, I'm seeing, okay, the stock closed at 605 and it opened here at 625. So it's opened, or sorry, no, it closed at 590 or something like that, 589, and then it opened at 625. So it's opened 35 cents up from the previous close. So already it's got a little bit of strength there. So that's the kind of thing I'm looking at, and I'm talking about a long play here. So when I'm looking at this particular setup, I'm looking to buy the stock low and sell it high, essentially. I don't think we're going to get like too crazy into a million different chart patterns on this particular podcast, because as much as you guys might want to know exactly what to do and exactly what setups to play, I learned a million setups to play that don't work for me. I can see them. Like the risk is too much, or they're just too volatile. Like there's so many different little factors that don't work with my personality, that like, even if I can see the setup, it's just something that I just can't make work for me. So I'm going to show you guys this one because it's called the ABCD setup. It's a pretty picture perfect one I saw from last week. So I just wanted to touch on that so I can give you guys a good example. It's probably the most basic long setup you're going to find. And then outside of that, I'm going to go into how to chart these things and how to track them, and what to look for and stuff like that. So we've touched on basically here that on this particular pattern, like for me personally, we have a long period where there's not a whole heck of a lot going on, and then all of a sudden we have one day where we got some movement going on. Some news came out, whatever. It's got a little bit of a gap up. I ran my scanner at 10 o'clock and I saw that it spiked up quite a bit, so I'm interested at this point. I checked the float on FinViz. The float is 32 million. It's right in my sweet spot where I know the stock has the ability to move a lot. So after that, the next thing we'll do here is
actually, do you want? I just noticed something. Do you want to hold on to that page? I just thought this was important. That was kind of interesting. Like the big green candle that you said that you were trading. Like if you can see the volume, that's a giant green volume candle. So there's a lot of shares being traded hands, right?
Yeah, exactly.
And like one of the things that I learned was like that's how you know that's a legitimate move up. There's a lot of volume. There's a lot of shares trading hands.
Right.
Whereas if you go all the way back, I think it was what was I looking at here? Like mid-December? No, mid or early December. There's a giant green candle on like no volume at all.
Yeah, so that's irrelevant, basically.
Yeah, that's some bullshit. That's just like a few people buying up the price. And then it's sold right off after. So it's like price manipulation even.
Exactly. So anytime like that, like you'll see these candles that are, it might be a big green candle, but it doesn't necessarily have a lot of volume. Like this one here is pretty decent. Like that's a pretty, it's got 10 million volume, so that could be something that's tradable.
But go back like 4 days, 5 days. Like you see, right, stop right there.
Oh yeah, this one here.
No. There's one from the one that you were just showing. Yeah. So if you see,
like these first ones.
Yeah, like that's.
Yeah. So yeah, if I jump over that, then it's suspect. Like 500,000 shares. Like that's nothing.
But considering the price move and that volume, like that's really suspect.
Yeah. So that's probably, considering that this move kind of crept up like this, that's probably, that could have been an institution buying. It could have been somebody knew some news that was coming out and they wanted to get in for this day, or that could be a million different things. But it's not something that's tradable. If you look at the 1 minute chart, then there's just not going to be enough volume to trade. When you look at the spread, which is basically the bid price and the ask price of a stock, something like this, just for example, if we're around $1 here, say, if it has a lot of volume, there's a lot of people trading it, your bid price is going to be $1, your ask price is going to be $1.01. and there's going to be a lot of people trading that, and that 1 cent difference is going to stay the same. So it'll go up to $1.10, it'll be $1.11, and that spread's always going to same. It basically it's the price that people are trying to buy the stock at and the price that people are trying to sell the stock at. But if you get into a really low volume situation, that could be massive. Like it could be the bid price could be 90 cents, the ask price could be $1.10, which means people have orders out to try and buy the stock at 90 cents, and people are trying to sell the stock at $1.10. So like when it happens, something like that, like if you were to buy because you thought the stock was going to go up, if you were just to buy at the ask price, you've bought the stock at $1.10. And now if you want to sell out immediately, the only people with buy orders that you can sell to are at 90 cents. So you have a 20 cent loss immediately if you try to sell out that quick. So that's the main reason why you want to make sure there's a lot of volume going on in these plays, is just so you don't get stuck in that kind of a situation.
Yeah, you know what that chart actually reminded me of? It looked like a very typical buy the rumor, sell the news one. Because you see the 3 days, there's 3 days where it was like the price was going up from like under $1 to like $2 even on very low volume. Then on the fourth day, where it was like finally the high volume trade, you get this giant wick up and it gets sold all the way back down. Like somebody was selling the news. When finally caught momentum, there was dumbasses buying. The smart people were like, nope, we're just gonna dump all our shit onto you. Yeah,
exactly. So like the reason that I wouldn't play, if we just pop back over to the chart here again, the reason that like this particular day here, just for argument's sake, even though it has pretty good volume, like 10 million volume it's decent. It's not like crazy, but it's still a third of the 30 million float. So it's still a good amount of shares. But we've already had 3 green days. So personally, I wouldn't look to go long on this day just because we've had 3 straight green days. And at this point, there's going to be a lot of people, anybody that bought down here is going to be thinking about starting to take some profits up here. And anybody that's looking to short is saying, okay, this has run up for quite a few days. Maybe I can go short, into the $3 area or something like that. A huge part of trading, and something that I'm actually doing a lot more reading in, is psychology. And that's how I base a lot of my trades as well for conviction. Is I try, like, you always want to try and think about what other people are thinking, because at the end of the day, when it comes to day trading, like most people are just guys like me who are sitting at their desk making decisions, right? So like when I look at this, I'm thinking, okay, like if I see this day that's green and it's up here and I'm thinking about going long, it's like, well, hold on. Like I know a bunch of people bought, way down here and they've been buying and buying. And, now anybody that bought down here at $1, we're up at $2.50. These guys are up 250% in 2 days. So like people are going to start selling because that's quite a bit of gain. So that's why I don't play anything unless it's the first green day, just because the first green day gives you the best odds of having a push up. So anyways, we'll get back on track here with this. So back to this 1 day here. So I'm going to go to the, I'm just going to find that day because it was a couple days back here.
Yeah, and I think it's important that people understand, like when you're looking at these candles and these price action, it's not something random that's happening. This is like a distillation of mass psychology.
Yeah.
Right. It's basically how the people, all the people trading the stock are feeling about that stock. It's all that these candles are. It's a reflection of that.
Yeah, exactly. This indicator that I use here, it's called the VWAP line. It's the volume weighted average price. It's this little orange line. You can get it on any trading program as far as I'm aware. It's great for intraday, like on the 1 minute chart, the 3 minute chart, the 5 minute chart. That's just what's listed up here. I always trade on the 1 minute just because that's the way I've learned and that's what I like. Some people trade on the 3 minute, some people trade on the 5 minute. It's just kind of a personal preference thing. But basically this line, essentially you can think of it as an indicator of whether or not people are mostly bullish, meaning people are mostly thinking the stock's going to go up, or they're mostly bearish, meaning they're thinking the stock's going to go down. So if I look at this, anytime I enter a long position, ideally I want it to be above this line, because then I know the general consensus is people are thinking that the stock's going to go up. So the ABCD pattern that we're looking at, in the most basic terms, this is as picture perfect as I could find in the actual markets from this last week. You're looking for essentially a big spike up and then pull back, another little pop, pull back, a third pop, and then it goes and it just rips up past that. So in a perfect world, you have, 3 distinct tops. And when I say distinct tops, I mean here's clearly a peak, here's clearly a peak, and then right back here, that's your third peak. And then in between each of those, you have a pullback. So, you got the first big pullback, and they kind of tighten up as they go. So this first one's pretty big, and then it comes up. The second one's a little bit smaller, comes up. The third one's even smaller, and then that's when you get the move that we're looking for. So one of the things, and I'll touch on this when we get over the Excel spreadsheet, is you really want to, when you see a setup like this, like I see this trade, and you look later on, like, okay, this stock's, it's gone up to $10.50 from the entry point of the move. So in in an hour, it's gone from $7.50 up to $10.50. So if you were to put 100 shares on there and hold it for that whole time, then you made $300, right? So that's the kind of move that I'm looking for. And the next step is, okay, how do we figure out like what exactly we're looking for? Like, how do we know where to enter? How do we know where to exit? What are the parameters that we're looking for to make sure this thing's going to work every time? So I'll tell you guys what I know just from tracking this pattern, and then I'll tell you how to go about finding new patterns and how to track them yourselves. So what I know from this particular pattern is there's variations to it, but the absolute best odds, like I'm always looking for odds. So like I want something to work 80% of the time. So the best odds are the first peak of the ABCD and where your entry point is should be as close to 1 hour as it can be. I don't know why. That's just something that I've learned after charting this a million times. I find if it's less, like if this exact same setup occurred over 40 minutes, the odds drop off significantly to whether or not this thing's actually going to push up that hard or not. And then if it was, if it was an hour and a half, again, with this exact same setup, the odds are way, way less. So right around 1 hour, an hour and 10 minutes is like absolute ideal entry above the VWAP line. That's the kind of thing I'm looking for. So what I do is basically I draw a line right from this peak, and I'll just have it touch down on this last top right here. So the other thing that I've noticed in tracking these is that this top has to push my trend line out away from this second top. So for example, if I just remove this line for a minute, just for argument's sake, if this came down and you can see this top here, we're going to touch that. So if it touches that line, and then let's say this peak only came up to here, like it kind of came underneath that white line, and then it broke through, then the odds again drop off significantly as to whether or not this thing's actually going to go up. So I don't know what the reasoning is. That's just, again, what I've figured out from charting. So far, we're up here. We have a big spike in the morning. We've had our second peak. We've had our third peak. We're 11 o'clock now. This peak is 10 o'clock. So we're exactly an hour. And then as soon as this pops over this line, that's where I'd look to buy, and I'd risk off of this previous low. So the low here you can see is 745, and then your entry point is 765, say. So you can get into this and risk 20 cents very comfortably, knowing that if it drops below this previous low, then the pattern's failed. Like I think I've seen one time or two times where this thing comes down and then it just completely reverses. Like it does not happen very often. And then at that point, you're just basically picking, what your risk want to be. Like, do you want to risk $10? Then okay, you buy 50 shares at 765, and then you're going to lose 20 cents at the most, and you're risking $10. Or $20 is your risk, then you buy 100 shares. Like, that's the next step is determining what you want your risk to be, and that's how many shares you're going to buy. So if you want to risk $20, you buy 100 shares, and then at that point, you see you get these big spikes all the way up. So the next thing that you want to look for, now we've determined, okay, we're tracking this pattern now. I've screenshotted a dozen of these things, similar setups over the past couple of weeks. We've kind of narrowed in that this is what we look for in the actual setup. We know on the daily chart it needs to be the first big green day after a pretty stagnant period. So what's the next step? Where do I sell? Like, if I get in here at 765 and it goes up to $8, should I sell? Like, if it goes up to 850, how long am I going to hold this? When do I know when this trend is broken? So basically what I do on that is, if we go back to the daily chart here, you're just looking for overhead resistance lines. So when I say overhead resistance lines, you're basically looking for on a long setup, it's typically a spike, and you want to hit the peak of that spike. And on a short setup, it's the opposite. It's a dip. Those are usually kind of your best resistance lines. So for me, like what I'll do is I'll pop over to the daily and I'll draw a horizontal line right there. So right at the top of this green day, there's a line there, there's a line there. And then, I'll just kind of work my way out from there. So, right there, this green day looks like there's a line. I'll draw another one here. I just put lines all over the place wherever I see. And then, you zoom out, there's nothing way back here, but the stock's obviously gone way up. So we'll scroll over to the left further. And, there's all this stuff up here. So you do the same thing. You draw in your lines, draw a line right there on this top. Zoom in a little bit. So, we just drew this line on this peak here. I'll draw a line at the very top. Here it looks like it hit this level. There's 3 candles that hit that same level. Draw a line there. Right here around 1150, it looks like there's quite a few days that hit that as well. And then probably the last one I would say is roughly in this area here, because we had these 4 days that kind of hit the same level. So that's what I do as far as like, and those would be my resistance lines. So every time it gets to one of these lines, I'm kind of thinking it's going to have a little bit of trouble moving up or continuing the trend. Let's get us back into the intraday here really quick. Is that okay, David? Or you follow?
Yeah.
Okay. Just want to make sure I'm not losing you.
I just noticed a different play from the exact same candle you were playing, like you were in the 1 minute chart, right?
Yeah.
And like, so what you were playing was you were playing the breakout.
Right.
And the thing is, I just saw another play. I know some people that, well, the guy me how to trade. He was a trader at JP Morgan. He's more conservative, so he won't trade the breakout, but he'll trade the retest.
Okay. Yeah.
So if you saw that it broke out above like $8 something, and it did a retest to 810, which was the previous high.
Yeah.
So he would buy that retest, and it just kept going up after that.
Yeah,
So
that's
he would do that. It's more conservative because he missed out on that giant chunk that you got into at the bottom.
Right. See, the only thing I've tried that before, and the only thing that I don't like that might be a spot where I would add to my existing position. But the reason I don't like that as far as a buy on like these intraday charts is because I don't have a really defined risk. Well, I do, but it's still where I entered. It's still that last low. So if you get that big move where it comes up and it comes off that, if, like I said, the entry is 765 and then it breaks up over $8 and then it bounces back down onto $8, I still have to risk off that 745 because that was still my previous low. So like my share size I could buy up there is like, it's 4 or 5 times smaller than what I could have gotten at the bottom. So like ideally that would be somewhere where I would buy at the bottom, sell a little bit into that peak, and then maybe I could buy those shares back on that first pullback. That's just like personally kind of how I do it.
So you're almost like maximizing profits, right? You're getting in as low as possible.
Yeah.
And you're
like
trying to ride it.
I don't even like taking plays that are 2-to-1, 3-to-1 risk reward. Like I like plays that are like, if I'm risking $10, I want to make 50. If I'm risking $10, I want to make 100. Like those are the kind of plays that I like.
Right.
So
yeah, I think that's an interesting thing. I think where a lot of people who are getting into trading should match their personality too, right? Because I would be playing the pullback.
Yeah. Well, you scalp right? Like you do.
I scalp a lot, yeah. So
Yeah.
like if it pulls back and it confirmed that previous resistance is now support, then that's a good high probability trade, right? So it's like whereas you're doing like a 2, 3, 4x, I might do like a 50% return, but it's like almost guaranteed 9 out of 10 times I'm going to get that 50%.
Okay. Yeah, that makes sense. Yeah, that's what I mean. Like it just you just have to play whatever works for you. Like it's the same pattern, but like both of us would play it different ways, right?
Oh, we're seeing it completely differently. It's like so interesting.
Yeah, exactly. Okay, yeah, let's pop back over to the chart and we'll just see how our lines kind of correlated here. So these are all the lines that we just threw in on the daily chart, and like this is exactly what David was just talking about. Right here is where he would buy in. So you see this and it breaks over. This is just a line that I drew on the daily chart. It breaks over and then it sits back down on this line. So
and if you pull back just a little bit, that was the previous high. That's how you know that the retest. Yeah, there you go. Yeah.
So this is the previous high. So it's broken out over that. It's broken out to new highs in the middle of the day, and then it pulls back down, sits on top of that. So for me personally, like what I would do to protect myself in this position is on this first move, I'd get in here in the 760s. I would sell probably a quarter up here just over $8, because then I know that gives me enough protection that if this was to completely fail on me and stop me out down here in the 740s, that quarter that I sold up here is going to protect me from taking a loss. And now I'm just going to get out of this play for break even. So that's that way, if I play 2 or 3 of these and 2 or 3 of them don't work out, at least I've sold that quarter. I've had a $0 day. I've had a $0 day instead of a losing day and a losing day. So that's why knowing where you're going to sell is also really important, so you can maximize your profits. But yeah, that's basically what I do. So I'd sell maybe a quarter here. And then at that point, you're really just kind of looking at all your lines and how they play out. So what I've noticed on these is, like, again, you can see everywhere that we got a little bit of a cluster, it kind of, these lines are pretty distinctive. I mean, up here, even this line we drew, that's where it topped off a few times. So, and these are, these lines were from, like, what was that, back in, March or something at the beginning of this year. So, and they're still, like, on this day, they all play in pretty effectively. So that's why, you always want to look way back on the history to find out where your resistance lines are. So when I would consider this broken is basically when any one of these lines get, like, broken with conviction. And when I say conviction, I mean, like, we have a huge red candle slam through one of these lines. That's when I would consider the trend broken. And then what I would do is, very rarely will it just come straight down. So it'll snap down and then it'll bounce back up, and I'll sell everything on that bounce. Like, that's how I would get out if it failed. On this particular play, it actually went quite far. So you can see here, I would sell, like I said, I'd sell a quarter here, and then I'd probably sell, maybe another quarter into this line, probably sell another quarter into this line. And then if this came back down here, and you can see it's kind of basing over this line, I might rebuy a few shares here, risking off of this low here now. And then capture this next move, sell another piece up into this next line. And then you can keep kind of doing that on the way up. So on here, it's come down again. It's kind of broken this line a little bit, and then it sits back up on top. So, I could buy a little bit more here, risking off of this previous low. And I'm always trading around that core position that I bought down here. So my average is still going to be pretty low, which is going to, give me a little bit more cushion on these positions. And then you can see it, it kept going and ended up breaking this 1042 line. And then it looks like this little wick right here, that touched, 1154 was the high. So that touched exactly on this line, pulled back, and then we had this big green candle, pushed up through it again. And then this is what I'm talking about for when the trend is broken. So as you can see here, like, it slammed right through this line, popped back up, and it held underneath it, and then it pulled down again. So, like, to me, when I see that, that's when I know the trend's broken. So if I still had any shares at this point, I'd be selling everything out on this next bounce here. And then you can see, for the rest of the day, it just kind of sold off. So all in all, if you get in here at the entry, 765, you could carry some of those shares all the way up to $12. That's I don't know what that would be, like an 80% move or something like that in about an hour. So those are the kind of moves that I'm looking for, is those really big gainers. And just try and maximize your profits as best you can, because if you buy at 765 and you don't really know why you're in or how far the stock can really go because you haven't tracked enough of them, then you might sell your whole position at $8 and you might only make 35 cents where you could have made $5-6 on your position. So that's kind of how I go about doing these. And then what I would do now is I would save this chart. I'd take a screenshot of this, take a screenshot of the daily chart, and then I would save it. I have thousands of charts saved, and then I just go through the whole breakdown process. So I will flip back over to a different screen here really quick. You look like you're thinking over there, David.
Oh no, I was just I just don't remember if we touched on how you identify these stocks. Like what's the step before that?
Like how to scan for them, basically.
Yeah. So
in the morning, every broker has a scanner, and they're all different. But basically, what I'll do is I just it's pretty simple. You just find whatever scanner you have in your broker. I'm not going to get into how to set it up right this second, because it's kind of it'll take a little while to go through all that. But I'm just looking for anything that's gaining. So like I might have 100 stocks that pop up that are over 5-10% first thing in the morning. and then I'll just sit there and I just flick through them all. And if I see one that looks like it's a good pattern, then I go over to FinViz, that website, check the float. If the float's 200 million, then I don't care. I ignore it and I keep going through, find the next one. If I see it, it looks like a good setup. You know, the float's 30 million. Okay, perfect. Then I put that on my watch list. Keep going through the scanner, you know, find something else that's up. Like maybe the intraday looks good, but I look at the daily chart and I don't like the daily chart because, you know, it's day 3 of a big run. So I know that it's not good for a long. So then I'll just ignore that one. And, you know, once you know what you're looking for, you can whip through them pretty quick and figure out exactly what stocks you want to have on your watch list. I mean, you're going to miss some, like some things are going to do different stuff, but for the most part, you can kind of narrow it in. But the only way you can get to knowing exactly which ones you want to look for is by basically at the end of every single day, like sit down at your computer, run a scanner for everything that's gone up that day, look at all your highest percentage gainers, and then just take a screenshot of the chart, and then, you know, go over to your spreadsheet and just fill out whatever parameters you think are potentially necessary. You know, like what was the volume, what was the time frame of the setup, what was the entry time of the setup, what's the risk, you know, what's the float, just, you know, anything that you think might be pertinent information. You know, what day of the week is it? Is it a Monday? Is it a Tuesday? You know, just like anything that you think might be relevant, and then just start tracking it. And then after a while, you know, tracking the same general setup over and over and over again, then you can kind of start to narrow your focus in until you find something that actually works. And a lot of the times it won't work. Like a lot of the times you'll see these big plays and there might be a setup in there, but, you know, I won't be able to see it, or you won't be able to see it, and you'll try and track it, but you know, it won't be something that's easily visible. So you just go on to the next one until you can actually see something and say and recognize it as it's happening, right?
So is there like some favorite assets or favorite stocks you like trading, or is it just you're just agnostic? You like whatever the scanner shows you, that's what you trade?
Anything. Like honestly, like it doesn't matter what the company is, it doesn't matter what sector it is. Like it's completely irrelevant. It's just all I care about is the pattern, the daily charts, and the float. That's really all. Like those are the 3 things that I look for. And as long as all those 3 things fit, then I'll wait and I'll just watch it. And if I see a pattern develop, then I'll trade it. If I don't see a pattern develop, you know, I might sit there and watch it go up 500%. But if I didn't see something that I know, then I'll just sit there and watch it go up 500%.
See, that gives me anxiety. I have to know what it is that I'm buying. Like even if I'm just day trading it, I want to know everything I can about it. It's crazy.
You don't have time for that, man.
Yeah, I know. That's the thing. I kind of feel like it's irrelevant too, but I just have this need to like just feed the data. Like I just need to know.
Yeah. Like I've had times where, like, you know, there's like this pattern, for example, like I've done it so many times now that I can recognize it really quick and make a quick decision. Like I've had times where it's the middle of the day and I pop open my scanner and, like, you know, I see a chart and then I look at it. I'm like, oh shit, that looks like a good pattern. I like pop over, check the float really quick, look at it. And, like, you know, within literally 20 seconds of seeing the stock, I'm already in the trade. Like,
and you're checking, like, so you're trading the 1 minute candles, but you're looking at the larger time frames for like your entries and exits.
Yeah. So the larger time frames are really good to find out like where your resistance is and like where I'm going to want to exit stuff. And, like, as you can see on that last thing that we just showed, like they're good indicators of when the pattern's broken as well, right? Because once you get those lines in, like once those lines break really hard, then you know that, you know, the selling is taken over and the stock's going to start coming back down. Which also on the flip side could be a good opportunity to start getting in short, right?
Right.
That's something that I'm working on now is you know, selling at the top, and then once that pattern breaks, flipping my outlook and starting going short and riding the backside down. That's something that I'm working on right now.
Yeah, I still have not gotten into I short futures, but that's different. Like I can't short stocks. It just gives me anxiety.
Yeah, it's the same as going long. You just gotta have you gotta have a risk, man. Like you gotta know exactly where you're gonna cut it.
There is that, but like it just, for me, the risk reward right off the bat doesn't calculate, because it's like if the stock, wherever, it doesn't matter where you buy it, if you short it, even if it goes to 0, your maximum profit is 100%. It has to go to 0 for that to happen. So it's like, what are you really fighting for? Like it's scary, right?
Yeah. Like for people that don't know, like when it comes to shorting, it's a lot riskier because you can lose more than your investment, right? So like if you have, just to keep it simple, like if it was a $1 stock and you bought 100 shares, if that stock goes to $0, you've lost $100, and you're not going to lose any more than that, right? But if you're shorting the stock, then if you short 100 shares of the stock at $1 and it goes to $3 and you're still in your position, you're down $200. So you've lost double what your actual investment is. So like, there has been horror stories where guys have, I've seen guys post, they have like, a $30,000 account and they short a stock and they try to swing it overnight, and some news comes out and it spikes way up. And not only have they lost all their 30,000, but they also owe their broker like another 50,000 because it's gone up so high. So like you can put yourself in debt shorting, which is why it's a lot riskier.
Yeah, I actually have a friend. He was stuck in a position for almost 2 years. He was playing on margin and he shorted the position. It was like an oil company or something like that, and it just went against them terribly. And it's like if he closed the position, he would owe money. So you just have to keep putting money into, just keep maintaining the account, hoping that the asset would go back up. Like it was just terrible.
Yeah, that's too scary for me.
Yeah, it was a six-figure position. Like,
oof. Yeah, no thanks.
But he's a gambler though. Like he trades the VIX.
Oh, really?
Yeah, like so, like yeah, like I don't even know what exchanges allow you to trade the VIX, but I know he plays it because he showed me his returns once. I was like, yeah, that one time you made like quite a lot of money, but how many times were you losing like a lot? Like so,
everybody has one good trade. It's it's the consistency that keeps you in the game.
Yeah, exactly. So you have a lot of charts, right? Or the Excel sheets.
Yeah,
because you track a lot of that stuff. I don't track anything.
Yeah, okay. It's good. Like I find, because again, like you're doing a lot of the investing stuff, so you're more concerned about the company fundamentals, right?
Yeah.
So that's not really something that you need to necessarily track. I mean, you could make spreadsheets saying, okay, these 5 companies have the same, whatever. Like I don't know too much about fundamentals. They have the same, generally the same profit, loss, revenue, whatever.
Right.
How do they all react over the next year, right? Like you can still kind of make patterns, and then that way you have set parameters to make your best trades. But like when it comes to day trading, like there's so many things going on, and like there's so many little variations that can literally make or break a trade. That like I said on that one there, like remember I said the third peak has to push, your slope line has to push it off that second peak. So if it doesn't, if that third peak is below that, then your odds drop like at least 50% whether that trade's actually going to work. So just 10 cents variance on that last peak is the make or break for that particular play for me.
Yeah,
so
it's a momentum thing, right? You want to see the price action try to break resistance, try to bust through it versus like just falling short. It's like puttering out.
Yeah, exactly. Down. Yeah. So that's why all these tracking is so important, because it just gives you a lot more confidence in the play too. Like, if I got a spreadsheet and I have, I got 50 stocks, I got 50 pictures of this setup and 50 different entry points, and I have all the percentages and everything's kind of like right within a range, and 9 times out of 10 it's going to work. Like the next time I see that, I'm going to be pretty comfortable going into that play, right? So it's it's all a mental thing too, right? Like it's something that allows you to not get scared out and actually let the thing go. Like I can say on that particular pattern, I've seen this 500 times. So when I get into that position, even though I've been in from 760 and now it's at 860, like I'm still pretty comfortable holding half my position, because I know from experience and from my record keeping that's probably going to go another 40-50%.
Right.
So,
do you want to show a bit of your record keeping?
Yeah, I'm actually, if you just want to pop over to my screen here, I'm actually just going to like kind of open just like a spreadsheet, and I'll just kind of go through like roughly what I would do. So like on this particular setup, like that ABCD thing, I'm just going to put in parameters that I think might be important. So I'd say, maybe percent gap up, right? That'd be the first thing I'd type in. I would say, price at entry, if I could spell. I would say, I don't know, percentage up from open. I would say, time frame. What's the time frame of the particular setup? What's the float? obviously what's the actual ticker of the company here as well. All right. So yeah, we were trying to type in this Excel spreadsheet here, and for some reason it was like making our screen share go all funky. So basically what I would do is, what you guys should do is once you see a move that, it's a big percent move and you're trying to break it down, this is the kind of thing that you want to do is just, type in the stock name, just whatever parameters you can think of. Like this is what I pulled up off the top of my head, percentage gap up. So like, what percentage is the stock up from yesterday's close? What's the price at the entry? What's the percentage up from the open price? Like it, maybe it gapped up 10%, and then from the open it's gone up another 10%. So this is, another 10%. What's the time frame of the setup? Does this thing usually seem to take place over half an hour, 2 hours? Like what's kind of like from where you start seeing the pattern happen to where you're getting in, what's kind of your time frame on that? And again, probably one of the most important is what's the float. So the lower the float, obviously the more volatile the moves are going to be. So that's another thing to keep in mind as well. But I mean, these things could be anything, it doesn't necessarily have to be that. I mean, if you guys want to use different indicators, like, like the simple moving averages or whatever, like VWAP is something I use. So I probably put in there, is it over VWAP? Is it under VWAP? If it is over, maybe what percentage is it over? It's all basically just a game of numbers. And then the more of these you get and the more of these you fill into your spreadsheet, you can set up each column and and to organize it. So like time frame, for example, you might hit that and you might notice that like, if the entry point on this is, between 10:30 and 11:30 in the morning, then the percent gain is usually 100. But if the same setup happens between 1 and 1:30 in the afternoon, the percent gain is usually only like 30%. So, maybe you don't really pay attention to the play at this particular time of day, or, maybe you still do, but, you're a little bit more wary of it. What's your percentage risk is probably another big one you want to put in there. Just all that kind of stuff, I think is really, you just want to really break down the play as much as you can with anything that you think might be important. And as you go through, you might find that certain things aren't important, just delete the column until you can really narrow it in. And then once you have a really good basis of data, then you can look at these charts and say, because the other thing is trying to see them in hindsight, right? Like, we're looking at this chart, it's already played out beautifully. Like, okay, great, it's easy. I see it, it's right there. But as that thing's ticking along, candle by candle over the period of an hour, you have to be able to recognize that and see it as it's happening, which is also, it can be tricky depending on the pattern. So that's all stuff to keep in mind. And then once you have that all sorted out, then, the first couple times you do it, you can look at it and, just have your broker open, pull open your spreadsheet, look at it and just look at it really quick. Okay, like, yeah, is the time frame good? Is the entry point good? Is the percentage gap up good? And if everything's kind of cross correlating, you can say, okay, everything's matching up with what I know should be a pretty high probability play. So let's go for it. And then you just kind of progress from that. But that's the key. And I mean, it doesn't necessarily have to be that particular type of play, but it's just about finding big moves that you're seeing on a regular basis, taking a picture of the whole chart so you can see the big picture, and then breaking it apart. Like maybe the first little chunk of the pattern, maybe that's not really something that you're able to break apart. Maybe you just can't figure it out. So go to the next piece of the pattern. Maybe it's shot up and it's doing something else when it's sitting up here. Maybe you can pick apart this piece of the pattern and use that as your setup point, right? So it's just all about breaking it all down and figuring out exactly what's going to give you the highest percentage and probability of returns.
So when did you start using the spreadsheets? It wasn't at the very beginning, was it?
I did. I made a few like at the very beginning, and then I kind of got out of it for a while, and then I got back into it. Like when I first started trading, I was trading mainly OTCs. And for people that don't know what those are, they're over the counter stocks. So they're basically not listed. They're like really like junky companies, like a lot of scams, a lot of illegal stuff going on. But the way they trade is really easy to watch, right?
I just wanted to mention, if anybody's seen the movie Wolf of Wall Street or like Boiler Room, that's what OTC is. that's companies pushing dog shit that exchanges won't list.
Yeah, exactly. Yeah. So it's not on the New York Stock Exchange. It's not regulated. It's basically just like a huge, like, it's just like a big crime ring. Like it's
Oh, that actually reminds me. Something I should point out. There is a lot of scams out there still, even with the SEC and all these regulations involved. I just had a friend of mine send me a stock to look into. Like I think it was just last week, and so first of all they were advertising on Instagram. They're telling people that they're to buy shares. Minimum investment was $200. And you could buy shares in this company. They're an energy company. They have this new way of mining lithium. Anyway, the website and the Instagram looks great, right? But so I started looking actually deep into the company because this is just the stuff that I like to do. And if you so they say that they're a Canadian company. Their head office is in Toronto. So explain to me how they're incorporated in Costa Rica, right? Probably because they want to get around the fact that you can't, as a company, just sell shares direct to the consumer, right?
Right.
You can get venture capital investment. You can get accredited investors, which means that they're high net worth investors. They're generally pretty educated on this subject. You can't just go to any Joe Schmo on the street and say, "Hey, give me $20 and I'll give you a share of this company." That's because most people will get taken, right? So that's why they're freaking incorporated in Costa Rica.
Unreal.
And the service they were using to sell the shares explicitly says in the contract that all we're doing is selling the shares. We don't know about this company. We have no, connection with these guys. Like all we're doing is facilitating the transfer of shares. You know what I mean?
Yeah, no red flags there at all.
Yeah, right. And so, like, I just want to point out to people, even as any kind of a trade, this kind of a thing is a red flag. I mean, so this company is trying to raise like $2 million. They apparently have this new mining technology for lithium, which, by the way, they say they do, but they don't show a prototype. They don't have any data. They don't have any mines. They have nothing, right? It's just basically a website and words. Right. And they're saying they want to raise $2 million, and they actually have a pretty detailed breakdown of how they're going to spend the $2 million, right? Apparently 150,000 of it is going to go into making the actual machine. And I'm like, I don't know what you make, but $150,000 might get you a day's worth of work.
It's like the price of this SUV.
Yeah, right. That might get you a copyright, application. Like that's not going to get you shit,
Unreal.
right? So I'm like, so these guys are going to raise a bunch of money from people off Instagram, and they're just going to run away. Nobody has any recourse because they're incorporated in Costa Rica, right? So like, it's just So that's kind of
it happens all the time, man. Like, but that was so big in the OTC markets. Like that happened all the time, and like. Right when I first started trading, that's what a lot of the guys were trading is because the OTC markets were still pretty active, and they're just like we'll get into this more later about like reading like level 2 and like the time and sales and stuff on like the charts, but like basically like you could sit there and like they just move like so cleanly. Like it's not like you look at the stock we were just looking at. There's all these candles wicking all over the place and it's kind of messy. Like an OTC would be like. For the most part, they're like nice, beautiful curves. Like everything flows so clean. Like, if we hit a new high, if it hit that 1 cent high, 95% of the time you could buy that and it's just going to keep going. Like they were like, I'd started trading those and I was profitable for my first few months trading those and I didn't know anything. And then they basically just like withered off to nothing to now at the point where there's no OTCs that like, you get one maybe every like month that has enough volume to play. So like I don't even pay attention to them anymore. But I did used to make spreadsheets on those at the beginning. And then once they started dying off, I think it almost kind of hurt me because like I used to keep all my risk and everything so tight because that's the way you could do that on the OTCs because everything was so cut and dry. And then when I started trading all the listed stocks, there was just time and time again where I'd get into a play and I'd put my risk here and then it would, would flutter around and it would stop me out and then it would keep going or vice versa. And it used to drive me nuts because I'm like, where do I put my risk? Like I can't risk specifically off something. So I used to just.
Because now you're dealing with market makers. They're the ones that stop you out, those fuckers.
Yeah. So like it just drove me insane. But like I did eventually after a while start making, and you just have to adjust your risk and everything. But I think it's really important that people do make spreadsheets because I mean that's the only way you're going to have any real information as to whether or not that pattern you're looking at is actually viable or not. And then the other thing, if we pop back over to my screen, I just want to show one more quick chart here. So this here, this is just kind of like I just zoomed this in, but I have I have every month and everything on here. This is how I set up my profit calendars. The reason I do this, like, David, you wouldn't have to do something like this because you're not trading, potentially 3-4 times a day. But like what this is it's just another way that I can kind of keep track of where I'm at. So, when you look at this, I have the ticker. So I have 5 slots in here, and, Monday in December or whatever. And then I have like little time frames. So I have like between 9:30 and 11 o'clock, between 11 and 1:30, between 1:30 and 4. And I have, the first column is profit, the second column's loss. I'm not going to punch anything in here because it was making the screen go kind of wacky last time. But basically, like what this allows me to do is, I can punch all my trades in here. So, company XYZ, company 1, 2, 3, whatever, all down here, the ones I'm trading. And then between 9:30 and 10, I traded this, and, I made $100 profit. So I'll put $100 in here on the left side. And then maybe, later on in the day, I traded company 1, 2, 3, and it was 2 o'clock, and I lost, $50 on it. So I put that over here. And then that just kind of gives me like even a little bit more of a breakdown as to, maybe, over the course of a couple of weeks or a month, I can start to kind of see a trend developing and say, okay, like it seems like, every time I trade in the morning, my odds of being profitable are quite a bit more than when I trade in the afternoon. So, maybe I'm still making money in the afternoon, so I want to keep that in, or, maybe I'm only making like break even, and it's just mentally exhausting. So maybe, I just won't trade those hours anymore. Or, maybe in the middle of the day, I know that, I have some really good plays that I can make a lot of money on, but I have a lot more losing plays. So even though they're smaller, I have a lot more losing plays. So maybe, I should size down in the middle of the day and, put more focus in the morning, or, it just kind of helps you figure out exactly where your own personal strengths and weaknesses are on those things. And then at the end of every month, it'll show me the full breakdown. So it'll show me, what my average profit is per trade, what my average loss is per trade, my total profits, my total losses, and then my gross profit and loss. So it's just like, it's something that you really have to be aware of, especially if you're trading every day, because, things happen so fast when you're day trading that you can get, you can start rolling down, a rabbit hole really quick and end up, losing for weeks and weeks on end, and then not even realizing it. Whereas like something like this, I can look at this every day, and I can really quickly pick up on a bad habit forming. Like maybe for whatever reason, I've noticed, oh, like how come all of a sudden I'm always trading between 11 and 1:30 when I know that's a time I always lose, and I've lost for a week straight. Like what am I doing? And then I can readjust. So it's just a way that I can kind of keep ahead of myself and make sure that I'm staying on the right track. It's like I said before, like psychology is something that I'm getting really interested in now because it's such a big part in trading, but it's really about always constantly being on top of it, always constantly tracking, like even patterns that I know work, I still track them like pretty regularly just to make sure they're not changing, right? Because the markets are always adjusting. So it's just, I know you say you love researching companies and fundamentals. Like I love spreadsheets. I love chart patterns. Like I just love numbers. I love like being able to look at a million numbers and give me a result. Right. So like the more of those I have, the happier I am.
Right. I think, did you want to touch on real quick the different kind of traders there are? Because you're a through and through day trader, but there's like scalpers and there's swing traders and there's position traders.
Yeah. So there's like, when it comes to like day trading specifically, I mean, day trading can be correlated, like you said, scalping, like swing trading. So for me, I would consider myself, I'm just like a day trader generally. And like, what I mean by that is like, I'm looking for moves that are, pretty big. Like I said, like I'm looking for, 4, 5, 6 times to 1 reward to risk. Like I like to be in a trade for, 20 minutes to an hour, kind of are my sweet spots. Certain day traders though, like I know some guys that like, they love scalping, and scalping is basically like, they might see something going on and they see like a little channel develop, and they'll just pick away at that and make, 10 cents, 10 cents, 10 cents, 10 cents, and just kind of flutter away at that instead of, like me, for example, where I would just buy a whole bunch and then, sell a whole bunch. I just take that one big move and I do one trade. They might do 100 trades, but make, the same amount of money or more or less or whatever. Right. But that's the way that those guys like to trade. And then there's swing trading, which is, like you do a bit of swing trading too, and
that's as far as comfortable as trading that I'm going to get is swing trading.
Yeah. So that's basically like generally over like a period of a few days or weeks or even up to a couple of months. So like, a swing trade could be considered, I'm buying now on a Friday and I'm hoping it's going to gap up over the weekend and I'm going to sell on Monday morning. Or it could be, you know, I'm buying on a Monday and I'm expecting it to go up, so I'm going to sell it on Friday. Or like I'm going to buy it now and I'm probably going to sell it in a month or two once this plays out. Like swing trading is just like a little bit over a longer term. But they're all like, you know, bottom line is the longer your time frame gets, the more fundamentals you need to know about the company. Like if I'm going to swing something for like, you know, a day or two, then, you know, I just want to make sure the company is not going to come out with like an offering or bankruptcy news or something like that. And then, you know, I don't really need to dig like too much deeper than that. But like, if I'm going to buy a stock and swing it for like a week or 2 weeks or a month, like I'm going to probably want to dig in and know, you know, a lot about what the company's doing so that it doesn't crash on me or something.
Yeah, I think that's like one of the most important things. Where like the more short the time frame you're playing, the less variables you have to deal with. Right, you're basically trading psychology at that point, you know, the 1 minute. But if you're swing trading like me, I have to look at the overall market.
Right.
If the whole market goes down on Monday, I'm going down with it. So these are things that I gotta pay attention to.
Yeah. Right? Yeah. It's just whatever works for you, right? Like.
Yeah, that's the other thing I was gonna say. I feel like those who tend to enjoy the shorter time frames are kind of a little bit of adrenaline junkies. I mean, if you're a scalper, you gotta really love that. Just you know.
Yeah.
Right.
Yeah.
Whereas, like, I'm a little chill.
Yeah. Well, it's like I was saying to you the other day, right? Like I remember like I was reading in my book and I was like, oh, it's so relatable. Like this one guy was saying, he was saying that 95% of his yearly profits come from 5% of his trades. And he said the other 95% of his trades are all break even. Like he doesn't make any money on them. And the guy was asking me, he's like, well, why do you do that then? He's like, because I get bored. I gotta do something, right?
You can't not be in the market.
Yeah, and that's like me. Like you know, like not to that extent, but like I'm kind of the same way. Like, you know, like I have like my big A+ setups, like, you know, I really only see them maybe like 2 or 3 times a week. I really see like those big plays like I just showed you there. But I mean, like I'm trading every day because like I just, you know, I can't help myself. I need I love it. So
I gotta give props to you though, because I keep trying to talk you into trading Bitcoin futures. and you haven't gotten into it yet.
No,
that market trades 24/7, like it doesn't stop. Like freaking New Year's Eve, New Year's Day, I was still trading. Like
yeah.
See,
if I got an account in that, I would never leave my desk. Like you'd see me a few months from now, I'd have a big beard and like
leave your cave.
Yeah, I would not be able to leave my desk. Like, as much as I hate the weekends because I don't get the trade, like if there was markets open on the weekend that I was trading, it would be dangerous, man. I wouldn't be able to stop.
Yeah, it's like the same. I think Forex trades 24/7 too. I don't think that stopped.
Yeah.
That's a crazy one. I don't know anybody that trades Forex actually.
No, all I know is that I get advertisements about it like 24/7.
I've looked into it though. It's absolutely ridiculous because the price moves are like fractions of percentages, right? They call them pips.
Okay.
So the only way for you can make money off of it is if you're highly levered. They give you 100 to 1 leverage.
Yeah.
Right? So you open up account, you put 10 grand in it, you can hold like $1 million position. That's the only way you can make any money because you're moving like fractions of percentages.
Yeah. Well, that's probably another thing to touch on too is like the way that I trade. I remember we talked about this is like I don't use leverage on anything because I just like the idea of using someone else's money just like terrifies me. So like I only trade like cash that I have in my account, but like I know you use leverage your Bitcoin futures and stuff, right?
Yeah, I'm using 100x leverage right now.
Yeah, so like $1 is $100, right? So you can trade a Bitcoin essentially.
Yeah, so for $1 I can hold a $100 position.
Right.
Yeah. So if Bitcoin moves up 1%, I've just made double my money.
Right.
Because it cost me $1 to hold that position. While holding $100 worth of position, it goes up 1%. I've just made $1 out of it, out of my $1.
Yeah.
That's why leverage is attractive. But the problem is if it goes against you.
Exactly.
You've just magnified your losses. Like it's just it's a horrible feeling.
I know. That's the problem. Is it's like, it magnifies your wins, but it also magnifies your losses equally. So
yeah,
it's just always something to be aware of. Again, it just comes back to, risk management. Like always just know where your stop is and stick to it. Don't ever let it go through your stop. Like you can always get back in. Like I can show you charts where I've bought a stock, sold it a minute later, and then bought it a minute later again. Like, you know, it
I've
just
done that.
it did something that just like freaked me out. So I sold it, and then it came right back, and I was like, okay, we're still in the game. Buy it all right back in, right? So, you can always do that.
Did we touch on how you arrive at your stops?
Like how I
Yeah.
like,
How do you figure out what? Yeah.
so on that particular setup, it was just the previous low. So like I said, on the ABCD, there's one high, one low, two, and then three, and then that's when I'm expecting it to go. So I risk off of that third low, which is like the tightest one.
Okay. I know some people will do like a 2%. But if it dips 2% below, then they'll stop out or whatever.
I think that's useless because like that might not necessarily coincide with the pattern, right? Like if the specific pattern, if 3% is where the pattern's actually broken, then if you risk 2%, and it could easily just dip to 2%, knock you out, and keep going. So like that's why like the way that I always go about it is I figure out what the lot, like the stop loss, is going to be, whether it's 10 cents, 15 cents, 20 cents, whatever, and then from that number I'll calculate my number of shares that's going to be my max loss I'm willing to take, and that's the position I'll take on the trade.
Right.
Because like if you're ever doing a percentage, or like even if you're like, okay, I want to trade 500 shares, but I only want to take a $50 loss, well, your max stop is 10 cents. But what if the chart pattern dictates that a 15-cent stop is where the pattern's actually broken? Then that's a useless stop, right?
Right.
So
yeah, I have a habit of not setting stops at all.
I
think it's a carryover from investing though, because with investing, it's like I'm looking at, for me personally, I'm looking at something to hold for 5 to 10 years at least.
Right.
And so like it's irrelevant for me if the asset dumps like 10-20%.
Yeah, true.
Like at that point, like if something dumps 10-20%, if I'm looking, I just reassess the fundamentals. If it's still a good company, then there's no reason to sell. Then just it's irrelevant, right? There's to stop out.
Yeah.
So, but it's a little different with trading though. Like I will set stops because Bitcoin trades 24/7. So if I'm going to sleep, I'll set a stop.
Definitely.
Yeah, but other than that, I still have a habit of not setting stops.
Yeah, I always do, just because like it just makes me feel more comfortable to have a stop in there. But like just going back to like how I figure out where they are, that again just comes back to tracking the stock, right? So like I've on that particular ABCD setup, like I've seen it enough times that I know if it does dip below that that third low, then I know the pattern's broken. So that's how I find them, is whatever setup it's going to be, just figure out which, whenever you see that setup and it doesn't work, figure out what level dictates where it didn't work, and then that's where you set your stop. So, yeah, that's pretty much all I got, I think, for right now, anyways. And we should wrap her up.
Yeah, I think that's pretty much good. So we touched on everything. A little bit on leverage. I don't want to get too crazy on leverage, but just wanted people to know what that was.
Okay. Yeah, next week we'll get into investing and fundamentals and all that kind of stuff.
Yeah, we're gonna look at my favorite stuff.
The boring stuff.
Not even look at the charts whatsoever. It's mostly philosophy, to be honest. Like the guys that I follow, like they're just, it's just philosophy. It has nothing to do with numbers.
Yeah. All right, right on.
Cool.
So you want to like and subscribe?
Yeah, I actually just want to mention one more thing. So because we're so new, we don't know where our listeners are in terms of their knowledge base and whatnot. So if they could comment to say if we're going too fast or too slow or whatnot, just give us a little heads up.
Mm-hmm.
And then we'll know where to go with the future episodes.
Perfect.
Awesome.
Yeah, make sure you guys like and subscribe. Give us some support.
Awesome. Till the next one.
Yeah, see you later.
Later.